What's up? Damon here from Stock Barometer. When I tell people that I trade options for a living, the most common response besides "what the hell is options" is, isn't options risky? Isn't that riskier than playing stock? That's the question I hope to answer today. Because there is a definitive answer, and I think it's going to surprise most people. And you might think I'm biased, but I'm not. I'm going to give you the objective answer to this question. Let's start with an example. When you buy stock, what you're doing is you're buying shares of a company. When you buy an option, what you're doing is you're buying a contract. Which one has more value? Well, obviously the shares in the company will have more inherent value because you're purchasing a portion of the company. The contract will, by definition, have an expiration date. That expiration date will make the contract worthless someday. So at the beginning, people will think, well, based on these two things, something tangible like a piece of a company, or just a piece of paper that anyone can write, what's riskier? The piece of paper. But risk is defined by the amount of money you could possibly lose in an investment. So an example here that I'd like to use, that is a very common example and can be extended to pretty much any other area of trading, is when you buy stock, if you want to make a profit, you need to sell it back at a level that much higher than you originally bought before you make that profit. For example, let's say you want to buy Microsoft. Microsoft right now is trading at about 45 bucks. Your goal is to make 500 bucks on Microsoft because you believe that Microsoft stock is going to go up to 50 bucks. So what you do is you calculate how many shares of stock of Microsoft do I have to buy to make that profit. What's the answer? You have to buy 100 shares. If you buy 100 shares at 45, then you sell it when it's at 50, you've made 500 bucks. How much did you invest? You invested 4,500 bucks. 45 times 100 shares is 4,500 bucks. So you invested $4,500 into this method that can get you $500 profit. What's your risk? Your risk is what you invested. Your risk is 4,500 bucks. The thing about options is you can buy an option that mimics the stock at a much lower price. An option inherently has 100 shares of stock inside it. So if I buy an option on Microsoft stock and I have the same idea as you, I want to make, well, let's say I'm not going to aim at a certain profit, but I also believe that Microsoft stock is going to go up to 50 bucks. What I do is I buy an option and I wait for the stock price to go up to 50 bucks and I sell the option. Here's what's going to happen. My option is probably going to be bought at around, it doesn't matter. The idea is the option is going to be a lot cheaper than the stock. The option price will vary based on the strike price and the expiration date, but we're just going to say that for the sake of this argument, this option is worth 100 bucks. That's a very common price for an option. So the option that I bought for 100 bucks mimics your position in Microsoft that you bought for 4,500 bucks. Now, what's the profit I get? Here's the main question. Generally, if you buy a good option, generally, the stock price rising $1 equates to a $100 increase in the option's value. So if Microsoft goes from 45 bucks to 50 bucks, and I bought an option for $100, my option goes up to become $500. So what am I doing here? How much profit did I make here? I made 400 bucks worth profit, right? You also made profit more than me. You made 500 bucks worth of profit. Who won? Who's the bigger man in the end? Well, you made more money, but what was your risk? 4,500 bucks. What was my risk? 100 bucks. I got 400 bucks. What was my ROI? What was my return on investment? I invested 100 bucks. I got back an option worth $500 that I sold for $500. My ROI is $500. What was your ROI? You put in $4,500, you got out $5,000. Your ROI is a little above 10%. You got about 10% of what you put in back. What's better? Which is, the better strategy? Is it okay to put in $4,500 as risk to get out an extra $100 profit over me? Or was I right in buying something worth $100 and then having it increase to $500? What if I had the same amount of money as you and I also bought options? What if I bought $4,500 worth of options? Multiply that by 4, that's what I got as profit. Okay? So really, when I first got into options, this is the main idea that got me into playing options instead of stock. I switched from stock to options because of this. But you still hear people say, options are really risky. Why do you hear this? Who's saying this? Here's the main idea. When I buy an option, someone else must have sold me the option. So if I made $500 from this option, you lost $500. The person who sold it to me lost $500 on this option. There is the risk. The risk is basically unlimited. Because if Microsoft shoots up to the moon, you lose pretty much everything. However, even though this is true, options are offering us a myriad of strategies that allow us to limit risk. For stock, you've got two choices. You buy the stock or you short the stock. Shorting the stock, by the way, exposes you to unlimited risk. A common question on the Series 65 exam that investment advisors must take before becoming an investment advisor is, what happens if you put a stop loss on a shorted stock? The idea is you don't want the stock to go back up and lose too much money. How much would you risk if you shorted the stock at $30 and you put a stop loss at $35? What's the answer to this question on the Series 65 exam? What's your risk from 30 to 35? The idea is you sold it at 30 and you told your broker to buy it back if it hits 35, thereby limiting your losses. What's the maximum risk you expose yourself to? The answer is an infinite amount of risk, because there's no way the brokerage can ensure that you're going to buy it back at 35. The company you shorted might have discovered a cure for AIDS, cancer, Ebola, all at the same time, and now it's the most expensive stock in the universe. Because people on other planets also play stock. The point is, you can't limit that risk. But with options, you can. The example I gave you of someone selling me an option, and then I got a lot of money from that option and they lost a lot of money, they might not have lost a lot of money if they played the right strategy. Options, off the top of my head, we have about 20 strategies for options plays. And one of them, which is called a credit spread, allows you to definitely limit your risk. Definitely limit it. So unlike shorting the stock, where you don't know for sure if you can actually buy back the stock at that stop loss, when you do a credit spread on options, you know for sure, I can set my own risk level. I can sell at a strike price of 30 and I can buy at a strike price of 35 at the same time, which limits my risk to $500 per play. And you can actually choose. It's a smorgasbord, a buffet of risk that you get to choose when you play this kind of option strategy. You can decide you only want to risk $50. You can decide you want to risk $100 per option. It doesn't matter. You have those choices available to you, whereas people who play stock do not. Though, I don't want to sound too biased. I don't have anything against stock, but I just want to clear up this misconception that options are riskier than stock when in fact they are not. It's actually stock that can be riskier because it's more expensive and because you don't have the ability to limit shorted stocks loss if you make the wrong decision. So that's it. If you have any questions about this, leave them in the comments below. Peace.